Now, after a summer off, the RBA is holding its first meeting of the year next week to discuss, among other things, interest rates.
Always discussing interest rates. A decision is expected on Tuesday afternoon, with most economists forecasting the Reserve will cut rates. Economist Angela Jackson joins us. Angela, how do you rate the chances of a rate cut on Tuesday?
Look, I think the markets out there are rating it at around a 90% chance. So they really have priced it in. It's almost a dead set certainty. But I think what we know from the Reserve Bank is it's a relatively cautious central bank. So I would put it closer probably to a 50-50 call. I think there's a good chance they can move. They certainly have the rationale, or if you like, or the data to support a rate cut in the form of a very slow-moving economy. And we saw that in the latest national accounts that came out late last year. And we've seen inflation, of course, which has been great news, come right back down towards the RBA's central sort of target of 2 to 3%. So that headline figure is well within the band, and that core figure is well on the way at 3.2%. So look, it could definitely move on Tuesday, but in terms of what we've seen in the past and the history of the Reserve Bank, it does tend to hold its fire, both in terms of when it moves and when it starts to cut.
Well, the Reserve has been consistent talking about unemployment rates as being significant to any decision to cut interest rates. The next employment data is actually coming out after the Reserve meets this week. Could they be forgiven for being gun-shy about changing rates?
Yeah, indeed. So one of the things the Reserve Bank, and which has been holding it back, because I think you could argue, indeed, and I would argue that there has been the data there for the Reserve Bank to start cutting, certainly late last year, in terms of starting to cut interest rates. There are signs that the economy really is struggling, the private sector in particular, and there are those signs that inflation has come right back down. What's been holding it back is a couple of things, and that unemployment figure is one of the big ones. And that really comes down to, is unemployment at a rate that's consistent with inflation staying within that 2 to 3% band? Now, there are various views on this amongst economists. There are some that think unemployment needs to be higher before the Reserve Bank can really start cutting rates with any confidence at around 4.5%, and that's where the Reserve Bank has been. There are other economists out there that think actually you could have unemployment down at around 3.5% without causing major issues for inflation. It is really going to come down to that, I think, in terms of, is the Reserve Bank prepared to walk away from where it has said that rate of unemployment needs to be at around 4.5%, and I guess concede that perhaps it's got that wrong, and perhaps unemployment indeed can be lower, and that can be consistent with getting inflation back under control. That is really the central question, I think, today. And we haven't really seen any indication from the Reserve Bank that they've changed their position on that unemployment figure and where they think it needs to be. And that's probably the one big risk, I think, in terms of for mortgage holders on Tuesday, that the Reserve Bank will indeed decide that no, we do need to see that unemployment figure higher before we move. And so we're going to hold for another month.
Angela, I was having a look back over the history of the cash rate and also the standard variable rates. At the moment, the standard variable rate is sitting at about 450 basis points above the cash rate. Historically, it's been a lot closer to 200 basis points. If we go back 20 years, it was even under 200 basis points more than the cash rate. Are we actually being gouged by the banks at the moment that are making record profits?
Look, it's difficult. Obviously, the Commonwealth Bank this week, $5 billion profit for a half year. It's pretty phenomenal. Look, what we're seeing is globally there is a lot more risk out there, and so those margins have indeed gone up in recent times. So the break between what the Reserve Bank sets and what we're actually charged is quite large. But it's not necessarily the banks gouging, it's just the cost for them of raising those funds to then lend to us has gone up. And indeed, I guess that's one of the risks the Reserve Bank is also going to be weighing up at this meeting, of course. We've talked about domestic conditions, but internationally, the world has changed significantly since they last met. Donald Trump's return to the White House has put a degree of uncertainty. I think we were predicting it, but perhaps not even those of us that were a bit pessimistic about what this might mean thought that it would be quite this erratic, and we'd quite see the sort of change in the international economic environment that we're clearly seeing.
Yesterday, there was a report out from Anglicare that suggested and threw up the perennial debate of inheritance taxes and suggested that is one way for Australia's economy to move forward. It's always contentious. What are your views on an inheritance, or some would call it a death tax?
Look, it's a very efficient form of taxation, so I think it is something that we should be thinking about. The reality, of course, is that if we look forward, the cost of delivering services and care services in particular to an ageing population is only going to go up. We have to pay for that somehow, and at the moment what we're doing is really relying on the working age population, wage earners, in terms of funding those services. If we keep doing that, the imposition on those workers is just going to get greater and greater, and that's going to hurt our economy. Wealth taxes, whether it's a death tax or other forms of wealth taxes, are a much more efficient way of raising revenue. It's something we don't do a lot of in Australia if you compare sort of internationally in terms of taxing wealth. It doesn't distort behaviour in the same way. It doesn't lower living standards, and it can be more equitable. So look, I definitely say it's something we should be considering. We're about to enter an era where there is going to be a lot of inheritance at play, and taxing that at some degree to then be able to afford to lower the impost on wage earners is probably something I think we will be talking about for years to come. We have to raise more tax revenue, and I think the aim should be to do that in the most efficient, equitable way possible.